It takes a bit for it to do it.
And we're live.
Hey, welcome everybody to another episode of Ask Me Anything. Go ahead and get those questions into that comment box or the chat box. We're going to go ahead and go around the horn here in just a second. We've got a couple of announcements and a quick video. See you in about 14 seconds. All right. Hey, welcome everybody. As I mentioned, go ahead and get those questions into the chat box. A couple of quick announcements we got here today. So as many of you know who've been watching us for some time, we do have quite a few live events each week. So make sure you go to chrisnoggle.com to see what those are and also subscribe to our YouTube channel. Additionally, a couple times a year, we will hold a virtual event. And so we have our next 3-day live virtual event coming up here next week. And I'm going to put a link here in the comment box here in just a moment so you guys can go check that out. Because when it comes to building wealth and money and all that kind of stuff, having the right people around you, your network of financial experts, is extremely important. Because otherwise, if you're getting advice in silos or from this person, but they're not actually talking to each other, communicating, then you're just getting little snippets of information. So what we do is we bring together our network, our friends, our advisors, our partners into one event where they share their strategies. And so definitely recommend you check it out because there's a lot of stuff that you're going to learn there that can help you on your journey. So with that, I'm Brian Fouts up here in North Idaho. You guys were talking before we started. It's pretty cold. So how cold is it where you're at, Joe?
11, 10 degrees, something like that.
Okay, yeah, so we're a little bit warmer here, I guess. We're up in the 20s right now, but not a lot of snow. But we're going to get into the teens here next week and sunny blue skies. So it'll be interesting. But with that, I'm going to pass it over to Linus.
Thanks, Brian. Linus Nolt here from Hopkinsville, Kentucky. Happy to be here and provide any and all value I can. We got a cloudy 39 degrees and rainy here in Western Kentucky. So typical, January weather. Got some single digits coming up this weekend. Not really excited about that because they are predicting a foot of snow to go with it too, and a chance of some ice accumulation. That doesn't turn my crank. So I'm actually over here. This used to be more of a happy hour thing. Everybody have a drink, the strong kind, or a little strong. Today, all I have is an elderberry tea. I've been having a runny nose and stuff. Good stuff. Anyways, Kevin, go ahead and introduce yourself.
Hey, what's up, guys? Team, financial warriors out there, Chris Nogglers, investors, et cetera, et cetera. My name's Kevin Krause. I'm from upstate New York, the frigid cold, not that far from Joe, Chris, Shauna, et cetera, the team. Actually nearby one of our favorite mutual companies, Security Mutual Life. They're not too far from me, which is pretty cool. After starting my journey, finding all about them. I just came inside. I'm freezing my butt off. I was shooting little hoops outside with my 9-year-old son who was begging me to go outside and shoot with him. But now I'm here to help out the team, new to the team, and looking forward to helping out as many people as possible as I used to do. As a prior teacher, soldier, and first responder before doing this.
Awesome.
So on Jason.
Awesome to have you here, Kevin. It's good to see you. Yeah. It's good to hear another New Yorker in the house. Like you can't tell, right? Every time I tell someone about being booked with Linus, I'm always like, he's going to say he's from Hopkinsville, Kentucky. So, we all got our different places. I'm down here in the city, beautiful Orlando. Always excited to be here with all of you, see your questions. I already see some good questions coming in. So before, with the 3-day, here's a question. What's going to happen when you're no longer here? That's going to be my segment talking about setting up your family constitution, setting up, really getting a vision for your family. Where are you going as a family together? What are the values you stand for and what does it look like to live by them? What do you stand for and against? And the systems and processes, because I don't know about the other dads in this room right now, right? But I know that's something that keeps me up at night. So I've been working hard to bring you some incredible software that'll go hand in hand with the vault that will be releasing on that date on the 30th. So over to my buddy, Mr. Helock.
Thank you, Jason. Kevin, did you play basketball in shorts or did you have pants on?
Oh, I definitely was fully clothed, Joe. Thanks for asking.
Come on. I went outside to shovel today. I had my shorts, I had a jacket, had my gloves and my hat on. I was fine. It's like I said, it's about 10 degrees. It's nice weather out there. So
I kind of need all my fingers and toes to be helping people, on the computer, when they call in and want to start a banking policy.
Well, that's why Joe doesn't care about that stuff, because Joe can't use a computer. So we're good.
I just talk on the phone and answer the questions. That's my important job. That's the important one.
We're getting Joe.
We're getting lake effect snow, so I don't know if it's going to hit up to you, but we're getting pounded over here. So, but anybody out there, let's throw some questions in. Let's get into the question and answer part.
Well, by the way, I had a Joe experience here a couple days ago.
What's a Joe experience?
So a Joe experience. So I had to go pick up my son from school because he was sick. So I hopped in my truck. It was 20 degrees outside. I go to the school, but I had a client call that I had to take. So I had my laptop. It was in my truck already. I go to turn it on. It wouldn't turn on. Like, what's going on? It wouldn't turn on. It wouldn't turn on. And I realized it was so cold the computer would not turn on. I'm sitting like shaking it and getting all pissed off. And I realized, oh, it's too cold. So I put it up on the heater. 5 minutes later, it turned on.
So many times that I get into the truck on the phone and it just flips over to the truck and I'll go pick up Ariana, take her to rifle practice or pick her up, and nobody even knows that I'm on the move. So,
There you go. There you go. All right, let's go ahead and dive on into these questions. So, see here. MK Lassos says, can you talk a little bit about convertible term insurance? How does the process of conversion actually work?
Yes, we can. Linus would love to give us a little bit more insight on this one. This is something that he's dove deep into this. So,
absolutely. There's kind of two questions there. I'll address the first one. Convertible term insurance means exactly that. It's a term life insurance policy you can get that's guaranteed convertible to a whole life. And so as long as your money mentor is doing the due diligence on what type of convertible term to get you, they can convert it later on to a policy for infinite banking. So that's a way to get some death benefit on yourself, get some coverage in place, some guaranteed legacy for very cheap, obviously, as term, while you maybe clean up some of your own finances and build better financial habits before you begin the infinite banking concept implemented into your own life. Or, basically, if you just don't have the money to start a whole life policy, and then a few years down the road, it can be converted without having to prove good health at that point. So that's where that guaranteed conversion comes in without having to go through health underwriting. That's really cool. The process of conversion, say if you have a $1 million convertible term in place, it's not like you have to convert it all at once. It can be converted in chunks. Typically not a super small amount, but it doesn't now all have to be converted at once. And the process of actually conversion is easier than even getting the policy in the first place as far as the convertible term originally. So that part's really pretty easy.
Awesome. And one thing to add to that is I've had a client come in and say, hey, I've got a term insurance, I want to convert it, to that, but it was by some other company. So the policy or the term policy was convertible, but not to the companies that we work with that do infinite banking. It was convertible only to the company that person had written that term with. That company didn't do infinite banking, by the way. But that being said, the question I asked the client was, why do you want to convert the term? Because the reason you convert it, as Linda said, is because you don't have to go through the medical. Well, this person was in their, I think, late 30s, very healthy. They didn't really need to convert the term. There's no reason to do that because they got approved for a term, a whole life policy just fine. So, but as you said, though, I mean, I do have clients that want to lock in that insurability because you don't know that you're going to be insurable 2 years down the road. You might not be. I have personal experience with this. My wife is not insurable anymore. She's in her early 40s. Kind of a shock. So, so that's what it does. But that's a good question.
Yeah, Linus, can you kind of expand a little bit more on, like, a lot of folks don't realize that, well, I think there's two parts that maybe we didn't cover. You did, I missed it. One, if you have a convertible term with a company that doesn't support IBC, what to do with those policies. And two, what do we do with policies that are convertible terms, but they're really because we were doing it for a dump-in. So it wasn't like we put the convertible terms there to give the high liquidity at first. But what happens when you can convert it at year 7, 8, 9, or 10? Right, depending on how long that convertible term's on. I think those are two important things for people to understand.
I have a short-term memory. I'm just going to go with your last question first. So what you're talking about, Jason, is where there's a term insurance rider attached onto the whole life that's specially designed for infinite banking. And that term insurance is only required for the first 7 years to keep the whole policy tax-free or tax favored. Just avoiding it becoming a MEC, a modified endowment contract. So after those 7 years, we don't need the term insurance on there to avoid MEC anymore. And if it's, say, a 10-year term rider, which is pretty common, you'll have that window of time from year 8 through 10 to actually convert the term insurance in that term rider into a new whole life without proving health insurability at that point, just like you would with a standalone convertible term. So that's a really good thing to have under your belt if you even needed a term rider on your infinite banking policy in the first place. Your first question, Jason, would you mind repeating it?
Yeah, the first question was more about, like, I think maybe the I can say it, the divert Mijas 530. If you have a convertible term, but it's with a company that doesn't support the infinite banking concept, right? It's not one of the carriers that we're working with on a regular basis. What do you do then?
It's different for everybody. I would probably keep it unless it's for some reason quite expensive when it maybe wouldn't need to be. I've seen some ridiculously priced policies out there for final expense or for mortgage protection where there was very little coverage with a very high price. And once you get another whole life in place for infinite banking, it more than replaces the death benefit that was on the other policy. So then maybe you could actually cancel it, but probably just keep it. If it is convertible at the company where it's at, but that company, like Jason was saying, doesn't have whole life that works for infinite banking, then yeah, the only way the conversion or the convertibility is a benefit to you is if you are uninsurable, and then convert it to a regular whole life is still better than no coverage, but just depending on your own situation though too.
Yeah. And also we've oftentimes can take that term policy and we can go to the underwriters at the companies we work with and just confirm that it cannot be converted or it can be, because sometimes they do accept it from other companies. I've actually seen a list of the companies they do accept, but there's limitations to all that kind of stuff. So it is case by case specific. So, which is why it's always specially engineered, right? And thank you, Diva, for telling us your name. It made it a lot easier. Just your middle initial is an R. Got it. So there we go.
Can any of you give just a brief, and I'm always big on an actual example, provide a little bit more value to that individual asking that question.
Yeah,
come up with maybe two different ones, like one for a male, one for a female, and kind of like why. 5 years ago, I didn't even know about convertible term, and I think it's obviously a great tool and used in the proper way. But this is definitely an example would be great for here.
I'll give two examples. One of someone who used it this year because they were still learning about the process. They were working part-time. They had a solid career. They were able to earn a good sum of money, but they were still kind of learning about infinite banking, but their term lapsed. So they want to lock in, a convertible term or protection for the family while they were learning about IBC. So we put that in place and they converted a few months later. Like, that's one example. And then the reason I had Linus answer a question or ask a question about with companies having convertible term with companies that don't support IBC, because this is what you're going to hear, Diva. If you have a convertible term with a company that's not one of the mutually owned dividend paying companies that supports IBC, that's been profitable every year well over 100 years. And this is what you should be looking for. That's why we say that whole mouthful over and over and over again. Not just to sound, cool. It's because that's all important stuff is what we come to learn. And this is a farmer that working with to start his IBC process. He probably has watched more information, learned more about IBC. He's literally watched 400 plus podcasts on IBC in the last year as he's farming. He hasn't, but I told him, hey man, you don't know this yet because you haven't started. And so he went to take a $2 million convertible term, and he went to that carrier and he went to the agent who helped him get all the life insurance policies he has right now. And the guy's like, oh yeah, I can learn about this. I can do it. And he went, he designed it. I mean, he did pretty good for not knowing what he's really trying to accomplish, but it's still not going to have some of the things that a mutual company that supports IBC does. Like he was able to put something like paid up additions into it. He designed it where it's going to have some cash value faster than a regular whole life policy. The loan rate wasn't that favorable. There's some other things that were kind of funky about it that I was looking at. And so at the end of the day, I told him, you're probably better off. This is my advice I gave him. I said, you're probably better off keeping that term on your body until you get to your total human life value covered with whole life. Like that's what I'm personally doing. Like I'm carrying a $750,000 term and 2 whole life policies, because until I replace that 750 with whole life above and beyond what I'm allowed to be insured for, I'll just pay the, $30-$40 a month for the next 7 years to hold that convertible term. So,
and my next policy I want to get, which I'm hoping to get this year, when it'll have like a 10 years. So I have that 3-year conversion period. So I want to lock it in because you just don't know. So
yeah, my next policy I think is going to be with a bit more of a complex rider that includes 1-year term and combines it with PUA, where it's kind of like having instantly convertible term on the policy. And so I get a longer period of way more flexibility to convert it over time. Works great for me being younger, maybe not always for older people. But yeah, another example on the convertible term I could give is somebody I had recently where she came to me. We dug kind of into her numbers, her finances, and she was saving nothing every month. So that's a habit she's starting now, but she can't start an infinite banking policy without having, any cash flow. Basically, she's living paycheck to paycheck. She's only starting to save, but she needs death benefit in place, and she certainly wants to lock it in while her health is good. And so what we found out is that she pays around $40 a month for a $30,000 term policy that was some kind of specific product for final expense, but it's super expensive. So we were able to get her a convertible term for 10 years, $250,000 death benefit for, of course, this is quote specific, but it was in the low 40s per month. So about the same price, nearly 10 times the death benefit. It was amazing what we could get her. And, she's likely to convert that to a policy for infinite banking in the next few years. And actually that pricing also included some death benefit protection on her kids. That's also convertible when her kids turn 24. So it provided her a bunch of protection that she didn't have before, and basically without costing her anymore, because she's replacing the old policy with this new one. So it's pretty cool to be able to put that in place for her.
Yeah. And then what you're hearing right now, everybody who's listening to this, is the importance of having people that know the ins and outs of all these things, and not just one cookie cutter strategy, but ways to make this work. Because infinite banking is very versatile, and we have a full team that have a lot of experience. So when we have things like this come up, we can ask our entire team and get, multiple answers to get to the best one. So I love it. All right, let's go into MK Lau's. Wait, this is what we just read.
I'm sorry.
So hopefully this answers that question as well. Yeah. All right, I'm not going to read that name. Creative Studio says, give your opinion on debt consolidation companies, please. Ooh. So first off, we always got to say this, not financial advice. But I do have some experience with this because I actually used to teach financial education and credit consolidation, credit stuff. So a company that I have personal experience with many years ago is called American Financial Solutions. I definitely recommend checking them out. They're so when you look at a debt consolidation company, find one that is a not-for-profit, not one that is for-profit, because the motivations are very different. But yeah, so and that one, the one I just mentioned, American Financial Solutions, they have lots of different options. They have consultations, and they also do coaching on it. So, but I've had clients work with that company and had very good things to say about them. That's
You just said that was super cool, Fouts,
Yeah.
is they have the coaching, the mindset, because the reality is a lot of times debt is not a money problem.
Yeah.
It's a money pattern. And it doesn't really matter how much money you make if you have bad money patterns. So definitely having someone that can guide you. And there's software too. Like you can use the Vault. Like if you just want to see where you're at, you can sign up for the free, free subscription to the Vault for 7 days. Put your expenses in there and kind of get the best math of how to do it and start getting yourself out of debt. Because if you follow the common path, you're going to pay so much interest to the banks. Meaning just keep doing what you're doing. But if you have guidance, like Brian said, I think that's what you're looking for more than anything. And one thing I would warn, and again, we're not giving any financial advice, but I've had some nightmare calls where people have, let someone else take over their debts. And typically it's been like an attorney's office, which is weird to me, but what they do from how the people share with me is they stop paying on all the debts.
Yep, they stop paying the debts.
And the only reason I believe they're doing that, again, I don't.
It's to negotiate with the debt company.
They're doing it because they're looking to basically show the lender that, hey, this person's has no plans on paying their debt. And so then they make an offer later on saying, well, if you could get this much, and you weren't going to get any, but if you can get $10, instead of 100, would you take it? And that's kind of the route they go, but they end up wrecking their credit. They end up being really not able to do other financial things. It just puts them in a really bad light, Yeah.
So. And that's why I recommend American Financial Solutions, because they don't do that. Because I've had lots of stories, the same thing, Jason, where they go and do that to negotiate. What American Financial does is they'll go and negotiate with the lenders to reduce the premium or the interest, which of course is going to save you money. And then they will then pay the lenders on your behalf. But it does not, I've seen this before. The credit didn't change. The credit score didn't change. So yeah, you've got to be very careful about that and that kind of stuff. But I used to own debt. So back in the day, I actually bought personal debt. So like I would buy like $1 million of someone's debt for like $30,000. And it was 100 different people. And then we had a collection company that would go and negotiate with the borrowers to like, hey, you pay 10%, we'll wipe your debt out. And so it was really a kind of a backwards way of doing it. But that was, I love that because it really helped out a lot of people, but we didn't go after them. You actually went and worked with them. So, but I've been on both sides of that equation. So good question.
I know we're talking about consolidation of debt. Obviously a lot of stuff that we do with this team, is using obviously policies to pay off debt and get rid of things. Obviously there's other tools too. A lot of the guys, they use HELOCs. I'll say I'm one of those people who have used them in the past to buy different things, to use different things, whether it's high debt credit cards or other ways. But like Jason was talking about, your mindset, right? Your mindset, your money psychology. A lot of people don't have the tools to do those things or the knowledge base or the education. But if they're constantly spending, increasing their credit card, right? All the debt just continues to go up. Then clearly something needs to change. They need to change their mindset, what they're doing, how they're doing it. Maybe start with tracking. If they're not tracking their own income, their own expenses, their debts, etc., then they need to start somewhere, and that's where they need to start, and try to help change that mindset and use the systems that we can actually use, that a lot of us in this team can do to consolidate and help grow that wealth while you're consolidating the debt and increase your cash flow at the same time. It's a multi-tool kind of thing. In the service, I use the multi-tool. It's got a knife, it's got a screwdriver, it's got a different types of measuring things. It's got all these different tools, and with everybody in this team. We talk about policies all the time, infinite banking. This is definitely a tool that you can use. But in this case, the person was kind of asking more on the companies. Well, we know a lot of companies, and there's companies that we use, that could help with that solution. But as far as that specific companies, Brian gave some information on that.
I've had a few clients call me up, and now we're trying to get them out of that consolidation company. Found out that over 6 months, the one company was holding about $2,500 of that person's money, because this isn't free. So they would be putting in $500 a month, but only having $200 or $250 even getting applied to the debt. So, and like Jason said, the first thing that they do is tell you to stop paying your bills. That throws your 780 credit score down into a 550. Now they can hold you hostage, because now you can't get help from anybody, because nobody else is going to touch you because your score's so low. It's a horrible circle that they lead.
Absolutely. Yeah, the one that I saw, the American, they actually break out what you just said. They'll break out. It's like $50 a month is what they charge, and they show it right there. It's all clear and cut. So definitely be very careful with those companies. All right. Piers Morales says, "Hey, I'll just hit my 1-year anniversary with Security Mutual. Congrats. Love that.
Way to be, Paul.
Yeah. What can I expect as far as dividends, and how are they moved into the account?" So Security Mutual, I think their declared dividend rate's like 5.5, something like that. It's not a direct calculation, just to be honest, but they'll come in as paid up additions and just add to the cash value at the anniversary. So they come in automatically, because when we set up the policies and build them, that's the option that we choose, is dividends purchase PUAs, which is what funds the cash value. So it's all automatic.
Usually hit about a week after the anniversary date or so, something like that.
That's what I've seen.
They get applied on the anniversary date, but it'll take a few days for it to show up, and then you'll be sent an annual statement, and it'll all show on there. So that'll be interesting for you to look at.
Yeah, you show your actual dividends, right, or what you earned, for the year, and how much you have to pay to put back into the policy for the new year.
And I love this question. Paul's someone who came in, with the mindset feeling like this might be too good to be true. And now he is a firm believer, practitioner of banking and doing all the things. So congrats, Paul. That's awesome. You're asking these questions. Your dividends can do a lot of things, folks. They can, we talk about what's most optimal for banking. And that is having your dividend buy more paid up additions, because that gives you more death benefit, high cash value, and the likelihood of better dividends, right? But you can also do things like have your dividend pay the premium. You can have your dividend come to you in cash. You can have your dividend tied to an index fund, right? And I actually got 2 more of those questions. Hey, Jason, what about this form or this letter I get with this IDO? And I'm like, that's your paper airplane. Put it in the garbage. Have your dividend by PUA. But if you're going to be a banker, you might as well know everything that your system can do, just so you're aware, right?
Yep. All right. Laura is asking a quick question here. Will IBC work for me? I'm 64 and receiving Social Security income.
It sure could.
Yeah. So, without knowing your numbers on your situation and what you're trying to accomplish, you can't really say yes or no. But bottom line is will it work for you? Depends on what you're trying to solve or trying to accomplish. That's the real question right there that we would ask of you. Because then we can say, okay, based on what you're trying to accomplish, does it work with you and your situation? But to be honest, having a low fixed income does make it challenging. To be very honest, it does make it challenging. The more income you have, the more that you can fuel the tank of infinite banking. The more fuel you have, the faster it goes.
And the reason why, again, Laura, it depends. Like, it kind of comes down to, do you believe you can or you believe you can't? That's part of it. And then because either way, you're going to be right. And then the second part of it is what we talked about in an earlier agent meeting that we have every week, where, there's certain things for, if you're going to be an infinite banking practitioner, there's questions I like to kind of ask to make sure someone's ready. Because the last thing I want to do is start someone in this process that they're committing to for their whole life, and they're not yet ready. One would be kind of saving habits. Like, are you paying yourself at least 10%? Two would be, what is that gross income? That way it can tell us how much you can qualify for. And that way, like Brian said, we can look at what you're trying to accomplish and guide you. Say, hey, you might want to do this, but this is what you could do. And then it would go through like basic health questions. We'd ask you questions. These are some of the preliminary underwriting questions we ask before we submit anyone to ask Mr. and Mrs. Insurance Company, hey, would you accept me as your partner? Right. And the questions are, are you a smoker? Yes or no? Do you have any criminal history, probations or DUIs? Do you have any bankruptcies or things in collections? And if the bankruptcy's typically been within a year or two, and you usually have to wait at least a year to 2 years after it's been dismissed. 3 is, do you have any medical conditions, any mental health history, have had any surgeries recently? Are you taking any medications? And then your height and weight. Like, these are all things that add to the overall risk profile to help someone get approved. I think it's important that we speak that we are applying for whole life, and it is something you have to be ready as a strategy to be able to utilize and qualify for.
100%. Futbolo Abrusa says, I think is it worth it to take a $5,000 loan to invest in something that makes more money in anything? Well, that's just called arbitrage, by the way. So if you borrow $5,000 at 5% and put in something that makes you 12%, you're making a 7% spread. That would make sense because that's making you money. So that's basically the definition of investing: is to invest your money to make more money.
Here's what I'll say about that, though. Just for someone who's done this before, I think it depends on where you're at currently. What is your mindset? Like, are you in a fear, scarcity driven, I have to have this money, make more money? Or do you know, like, and understand it, and you have a lot of faith in what you're going to invest in is going to give you a return because you have experience? Brian, fun thing I was doing today, not only kind of revamping some of our training, but I went back and got all my debts because we didn't have the vault back then. And I found my old, pirate treasure spreadsheet and pulled up all the debts and all the calculations on it. And one of my debts was a painful one. It was a $50,000 loan from SoFi at 13.8% that I invested expecting it was going to give me all this cash flow. Well, that debt really over time would have cost me $72,000 on a non-performing loan.
Yep.
So it cost me $933.16 a month for 3 years before I was able to pay that off.
I've had one of those before too. You know what I did? When the investment went south, I actually called up the lender and I said, hey, the investment's toast. They locked the account, made it a fixed payment, no interest. Saved me.
Man, Brian, I wish I would have done that. I wish I would have known you then. Sorry to interrupt, but man, that just hurt a little bit.
That saved me $30,000. Yeah. So, but the trade-off was I couldn't use the account anymore. They locked it down because I said, hey, here's the options: I'll get money or get no money. They said, we'll take your money, but we'll lock the account and no interest. Yeah. So that was a win in my book right there. Okay, so we got quite a few questions coming up. Let's get through some of these. So Dex, good question here. Does it matter how policy loan is paid back? Example, daughter gets a policy loan. I give her policy number, the address, etc., to make the payment. Does that work? So he's trying to avoid going back to the bank first and then from the bank to the policy. So it depends on what company you have, but typically you have a bank account that is tied to the policy and it has to come from that bank account. I don't believe they'll allow you to send a personal check or that kind of stuff to the policy.
Yeah, they do.
But do they? Okay, for the loan paybacks?
You could do a personal check, money order, cashier's check. All those things are possible. And even doing, I know he's with One America, so doing an online policy loan repayment, she can even do that, with her bank account information, where it's an electronic transaction. Yeah.
Nice. Now, the premiums are different though, correct? The premiums, they won't let you do some of that stuff.
Yeah, that could be done too. If you do that though, they'll probably change the payer of the policy over to whoever just paid it last. But that's even easier. Well, either one, any payment with One America, you just make it over the phone, make it even easier.
Yeah.
They'll process an electronic transaction. And if you guys are both on the phone, it may need to be both on the phone, I should say, for that. Or what I should say probably is the policy owner and whoever's trying to pay it probably need to be both on the phone to make it work. But yeah, that would be potentially the easiest.
Yeah. And just keep in mind, why does the insurance company have rules and stuff about how you fund policies and the bank accounts, the names and the accounts? It's money laundering. So they're wanting to verify where the funds are coming from, and they want to make sure there's a paper trail, bottom line. And by the way, I have caught someone trying to do this. And it's very interesting when you're on the phone and you start to pick up that hey, something's not quite right here. They're trying to launder money. And it's hard to do today versus, probably 20 years ago, but that's what they're looking at. Yeah. So here, I'm not sure. So Flutable Rusa is asking from a 401k. So I think they're talking about funding from a 401k. What was their previous question? Oh, so
we're taking a $5,000 loan.
The $5,000 loan to invest it into, if from a 401k. I mean, that's financial advice right there. As Jason said, it depends on a lot of factors. What you're putting it into, the risk tolerance, your knowledge, your experience. There's a lot that needs to go into that to answer that question. But I mean, it can make sense, but it has to make sense to you. So
you also got to look at it for the long term too, right? It's not just hey, you're taking 5,000. What about next year's, depositing next year, right? How many more years are you going to be funding this system? You're going to need to know, what you're going to be doing and planning that out as well.
There you go. So Brandon Malone asked a question: can you benefit with just a term policy like whole life? Not like whole life, no. But how do you win with term insurance? Anybody want to answer that question?
Well, I don't know if you really win, because I mean, the only failure there really is, right? You don't get rejected. You don't fail until you die, right? You keep trying. So the only time term is paying out and giving you that reward is if you're no longer here. Is that what you meant, Brian?
Yeah, which is, you don't want to win with term insurance, but you always win with whole life. That's the way I try to explain it. You're always winning with whole life because you have living benefits. There is no living benefit to a term policy. There is only a death benefit. So there you go. All right. So Elmo is asking, my husband contacted his financial advisor right there. First mistake. And asked him to set up this one. Yeah. And asked him to set up a whole life for infinite banking. And he told him it was a scam. He said he gets all of his money up front, 90%. So that financial advisor, I'm going to be very nice here, should be fired. Because he just lied, or he does not have the right information, or is not very knowledgeable. But if I had an advisor that said that, I'd go find a different financial advisor. Was that sugar-coated?
I mean, we could expand on it a lot, but
oh yeah. I mean, I've written policies for financial advisors because they had the right mindset of, hey, I don't know everything. I looked at this and said, hey, I like infinite banking. I don't know how to do it. So I'm going to go find the person that can do it for me. Even though they're a financial advisor, I've written multiple policies for financial advisors because they had the right mindset. What are you going to say, Joe? Yeah. But I haven't talked to a traditional financial planner in a long time.
Ask his financial advisor if he'll give up 60 to 90% commission for building a life insurance.
That's what I was hoping you would say right there. Yeah. So what I'd want to know is what did the financial advisor try to sell him after he said infinite banking was a scam?
Let's see what that looks like.
And then find out how much the advisor is making off of that.
And then we can say that he's a scam.
Yeah, that's the true story right there.
One day I walked into my local Woodman of America financial place just to see what they say if somebody comes in asking about infinite banking. He's a licensed insurance agent, not a financial advisor, just a licensed insurance agent. And he was pretty blunt. Yeah, that crap, that's a scam. But here's what can work. And he proceeded to present me an IUL and what it does and how it works. And so we kind of got into it. That was interesting. But on the flip side, I've helped many licensed insurance agents. I've written, the policies for infinite banking for them, simply because they don't know how to do it. They're not even contracted with companies that work for it. Like they're brand new to it, so they're relying on us, and so that happens a lot too.
Mm-hmm. Yep.
Here's what I'll add to that, and everybody, I love what everyone said. So it's great information that's being shared. The common path is what most people are doing. You know, the common path is accumulating your money for later and then coming down the mountain, which is the hardest part, by the way. It's one thing to build up the mountain. It's really hard to come down the mountain because there's a whole lot of more variables. And so when you're asking someone that's a financial advisor, you know, you have to remember what they're taught and what their belief system is. And most of the time it's have it in the market, have money under management, you know, diversify. That's kind of common advice. The question you want to ask yourself and your husband, how is this working for you? Has it worked for you? How confident are you that you're going to get to your goal? And if you're not, then if you're curious enough, why not learn about the infinite banking concept? Because I had another guy ask me today, he's like, hey, you know, I'd like to see like 5 different illustrations on this based on all these designs. I go, yeah, it's cool. I won't do that. Someone will, but it's not me. And here's why. Because I'm here to solve your problem. I'm here to understand your money situation, where you're at today. And then we're going to find out how much do you want to put into this to reach your goal. And then you'll have an illustration. Then I'll teach you how to read the illustration, right? Like it's we're not just throwing stuff at the wall and hoping, oh, this looks good. Here, look at this, look at this, look at this. No. Right? So it's a common versus an uncommon approach to bring it back full circle, right? So which approach do you want? What's working for you and what do you want to happen?
Exactly. Yep. All right. Streeper says, so if you don't have the money to pay your premium 1 year, if you're paying annually and you have 2 policies, can you take a loan and pay your premium on the one with the other? Or would it essentially be, as you talk about with the HELOC situation? So it's an interesting question here. And I want to kind of jump in here for 1 sec. So you can always go to monthly, by the way. So that'd be the first thing, is go to monthly so that you're not having this huge amount going out. So we have a lot of clients. I have clients that are doing that right now. Annual first year, monthly second year. Now, borrowing from the policy to pay, which is a loan to pay your premium. If you go back and study infinite banking back in the early 1800s, what you just explained is actually why the loan provision was created in the first place, to maintain premiums during the low times or slow times and pay the back during the good times. That's why loans exist. So you can, but I mean, I would look at all options, and there's multiple options, monthly, reduced premium, etc. But it's kind of interesting if you study that. That's why the loan exists.
And he's got a money tree in year 2. So when he spins it around, he's going to take most of it back out, and then he can spin it right back the other way.
Some of the times, Joe, I love how he's here learning every week, but some of the times your thinking worries me, my friend. Some of the questions like this. But yes, that is 1848 is why loans were started, is because of this exact reason, because life insurance is for the death benefit. I'll repeat it. Life insurance is for the death benefit that's guaranteed. So back in the 1800s, guess what? People's money habits sucked too. Yep. Just like today, 1900s and 2000s. It's going to be the same until we change. So
they had pretty volatile income back then, though, as well, because guess what there was more of back then than there are today? Farmers. Seasonal income. So yeah, so I love studying that kind of stuff because it's just weird about how they came about with this thing. Honk honk.
Who's that? That was fun.
That'd be yeah, that was Kraus.
I think that was me saying the text.
It was me and Linus. Yeah.
There you go. That's funny. But also, the question I'd be asking is the why. So if that situation does come up, why is that the situation? Like that's what I would first ask. Oh, I have something else happened and my income went down, something like that. So I don't want to be asking why you'd be thinking about doing that. But, yeah.
So if you have a loan out and it's going to come back and you private money lend or something like that, and it's waiting to come back in, you can drop it to monthly. You can use the one to pay the other one until that comes back in. And then when that money comes back in, now you can build it back up and you'll be back at status quo again.
There you go.
Just a little dip.
So Christian, so obviously he's been around us quite a while. So I love this one. If we have our dividends come as a check, so by the way, everybody, you can choose to have your dividends come to you as cash. You can do that. Wouldn't that create a tax liability instead of buying extra PUAs? Yes, eventually. So you have what's called a cost basis, which is what you put into your policy as premiums and dump-ins. Call it $100,000. If you pull out dividends over time and you pull out $110,000, your cost basis is $100,000. You have a $10,000 taxable liability or taxable issue. But I mean, at that point, though, your policy would not be growing though either. So it wouldn't make a lot of sense.
And Nelson talks about this a couple of different. Sorry, Joe. Talks about this a couple of different places where he had one of his old, I think it was a New York Life, just regular whole life policy, pay the dividends in cash until he got to what Brian just talked about, till he got the basis, which means how much did you put in, and then he started taking loans after that.
Yeah. Yeah, and they. Yeah. Go ahead,
Christian, the purpose of having the dividends reinvested is so there is no taxable liability.
Yep.
So when the dividends are reinvested to go back in to buy extra PUA, not only do you have extra cash value, but your death benefit increases also. And then you can just turn around, go back in and borrow that money again and put that in your opportunity or whatever you're doing with it.
Yep. And this kind of dovetails into Anton's question here, which is asking regarding annual dividends and interest earned. By the way, it's dividends. It's not, there's no like and interest earned, it's just dividends, by the way. How is that applied on the anniversary of the policy? So I think we kind of answered that already, didn't we?
Yeah.
So
Dividends are put in on the anniversary, shows up about a week after.
Yep. PUAs, paid up additions. And the one thing I want to kind of clarify this because I get this question a lot, and you guys might get it as well. Oh, so let's say the dividend rate is 5.5%. Oh, so I'm going to see a 5.5% growth to my policy. No, the calculation is not simple, by the way, but remember what we just said. Dividends are purchasing paid up additions. We didn't say dividends are, the amount of 5.5 is going into cash value. It's purchasing PUAs, of which 90% of the PUA goes to cash value. So if your dividend is $1,000, 90% of that, or 900, is going to show up in the cash value approximately. So there's a lot of calculation behind the scenes. So anybody else want to add to that? Because I get that question a lot now, it seems like.
No, I mean, I can talk about be a little bit more detailed with it as far as like the load, depending on the carrier. There's always to my knowledge, there's always a load. I hate using, always and never, but it's there's a load on the paid up addition. And someone asked me this other day, Brian, where he was like, hey, I see I get 94 cents of every dollar I put in. What happens to the 6%? And I was like, well, you're buying whole life insurance first. So there's a cost of life insurance. You have someone managing your policy. You have other things baked into that 6%. But that, if you're looking at it in terms of having tax-free money that's growing for the rest of your life, if you're putting $100 in and you're getting 94 new cash value, it seems like a pretty good deal to me. That's why we advise that so often. So
yeah.
Another thing that isn't brought up enough, your policies are getting better every year.
Yeah.
So are we talking in year 1?
It's like,
3? Are we talking in year 5? You see what I mean? So It's not all the same. Every year, the interest rate goes down, makes you more. The compounding interest goes up. So every year, this gets better and better. So it's tough to answer specific questions if we don't know what year we're applying this to.
Yeah. And I've shown that spreadsheet to people because they do the math and they're saying, I can't quite make the math work, for the dividend. I go, you won't, because it changes every year. Like you're saying, it gets better. And that's what he goes, yeah, it seems to get better year over year. I'm like, it does. And it just starts to accelerate. And so the math is, mathematically complicated. But every company calculates dividends slightly differently. That's the bottom line. Every company is different. So every policy is going to be slightly different. So that's why sometimes you'll hear us to speak, hey, it's generally around this number.
in year 4 with my policy, with the amount of money that I paid back in interest to the amount of money that I received in dividends divided by the amount of money that was borrowed out, I was at 0.375% interest. So, everything gets better as we talk. In the beginning, you're borrowing it at 6.5. We're getting dividends of 5.9. That's not the same case in year 2. It's better.
Yeah. That's a big one I get right there. As I say, well, that's a negative arbitrage. I go, kind of, but you're trying to compare apples and oranges in reality. And Chris has a different opinion on this one than I know even me, but they're not even the same interest rate. They're not even calculated the same way. They're different.
Mm-hmm.
Yeah, that's one I've done presentations on before because there's a lot that goes into it.
When I break it down with somebody and I said, if there was something that you were able to put money into, and after so long you were able to take out more than what you put in, did it cost you anything?
Yep, that's a good one.
And Dario, I don't know if we're gonna get to his. We got a couple minutes left, but Dario, hey, thanks for being here, listening to us. It's awesome that you're practicing. Hopefully, you're not sitting in the closet of one of your restaurants right now to listen to this. But if you want to get your daughter started, I just sent you my link so you can schedule a call with me. She most likely won't have to do the paramedical. It just kind of depends on what they see going through underwriting. But typically, if you're under 50, depending on how much we're applying for, they don't always need to do the height, weight, blood, and urine. That's complimentary. So
yeah, we'll get through these questions. Last ones here real quick here. So Craig, this is a good question. Let's pretend I heard about infinite banking 5 minutes ago. How would I know what I want to accomplish? So first and foremost, I will not answer that for you. Me personally, I wouldn't. I would actually send you somewhere to go do your homework and go get educated, because I can spend my time educating somebody else, but we have a lot of resources. We do at the BYOB here. So I would actually have you go read Nelson Nash's book, Becoming Your Own Banker, have you go watch our 90-minute presentation on infinite banking, and have you go look at Chris's YouTube channel. That's really what I would do, because we have all the resources to help answer that question already. So I would just point you that direction. Now, that being said, if you asked that question 20 years ago, it'd be a very different answer, because all these resources did not really exist except for Nelson Nash's book. So today we have a lot of resources.
I would say if you
really good question,
then you would want to get out of debt first in order to climb to the next ladder, and then keep bringing that on to investing and making cash flow, yada yada.
Yep. No garage guy. And I can't remember what kind of vehicle that was. It was we asked it last week. But this is a great question that is probably one of my favorite ones. If the insurance company collapsed or ends, does your policy die with it, or are you deposit protected from company's bankruptcy? So to answer that question,
thanks. Yeah, I'm more afraid of the bank collapsing than the insurance company. I'll tell you that.
It's a good question. Let's answer the question directly, if we can.
Yeah, they've never gone under. So these insurance companies have never gone bankrupt. They've never gone collapsed. They've never lost money. So, and they also have 100% cash reserves, which means they can pay out every single death benefit and still do business. Knowing that, and knowing that a bank has 10% cash reserves, which one is a better financial institution? Now, my fun answer to this question is if they go under or go bankrupt, knowing how solvent these companies are, how much money they have, your policy is the least of your concerns. Survival might be your better focus. And I'm being very serious when I say that, because for that to happen to an insurance company, it means the economy has probably collapsed 100%. Money is gone out the window. And we're in some dire situations.
We're already doing bartering system at this point.
Yeah. Well, there's also, just so you know, it's state statute. That's one of the ways it stays out of Tio Sam's, hair, right? We don't want him involved with this. And so you have guarantee associations that are there to also to insure the insurance companies. And that's a state by state thing. And everything Brian said is accurate. I used to tell people, hey, you're more likely to have the world end than have one of these whole life companies go under, because they've been profitable every year. And the way they're set up, I mean, they're just built on actuarial science, which keeps saying we're getting older and healthier, and they keep extending the tables out further. So, that's why they're so successful and so solvent. So you can do your homework on that. But at the end of the day, they're also guaranteed by guarantee associations, right? By other insurance. So there's that too.
I mean, we're talking billions of dollars
Contingencies.
Hundreds.
The one company did a what was that?
One
James?
America.
One America. One America did a test that if they had to pay out everybody during COVID, they still had something like, well, what was it, 10 million or 20 billion left
Yeah,
over?
it was a huge number. They could pay out every single death benefit and then keep on doing business.
Yeah.
But if everybody died, I don't think the insurance company is going to keep doing business because the entire population is gone. But that gives you an idea of how liquid they are. I mean, how much capital reserves they have. It's incredible.
Yeah,
They're more stable than banks in most opinions.
No, they are the bank.
I'm sure another insurance company would absorb another insurance company too, especially with reassurance that we've talked about with policies doing reassurance.
To answer that question with what you're talking about, so stock companies have gone under. And what happens is all the policies get gobbled up by other stock companies. So nobody lost out really. And I can't remember the company's names, but they did go under because they're a stock-based company, which that's why we don't touch them and you can't do infinite banking. But in those scenarios, the policies did get gobbled up by somebody else. So kept on doing business. Your policies.
That was a great point, Jay. What you said. If the banks are taking their money and putting it into life insurance, why do you keep your money in the bank? Don't make sense, does it?
No, it does not.
That's why we keep it in the insurance company, just like the banks do.
Yep.
Bowley.
Yeah.
Has its own name too.
One of the coolest things I ever heard after learning all this stuff.
Yeah, you don't need medication for that, by the way.
Yeah. Hey, Diva, just so you know, yes, it is going to be with one of the people you see typically here on the screen. That's why we gave you that link. So you put it in there. So that link I just put in there, if you use that one, it's AMA-RR. It'll be with one of the people here that's on these events.
And for everyone listening, we do this every Wednesday, 4:30 Eastern, all year long. There's barely a day we miss. So.
Yep, except for the holidays.
Sometimes.
All right. Sarthak says, hello, gentlemen. Appreciate the time. Could you add a level term later on in the policy to be able to add the PUA when income increases? Is it a policy standard that PUA ability is 3x times base? So you can't really modify the policies after the fact. You can't add term to it to then change the overall structure because now your underwriting no longer applies. So they don't do that. So that's why people do second policies is because, hey, I want to put more through it. You do a second policy because we cannot change the main structure of the existing one. But I mean,
during the strategy call, if you want to add different amounts or whatever, that can be built in the beginning.
Yeah, because the problem is that what we try to, some people want to build this thing for every single scenario that could potentially happen. You can't do that because if you start doing that, what happens is the policy becomes inefficient. You start losing the efficiency because all these different scenarios are built in. Some happen, some don't, and then all of a sudden it's not working like it should because we were guessing at the beginning. So we build it for what we know with certainty is going to happen, and then if something does change, that's when more policies. But I would say, most of our clients, probably over half of them, are doing a second policy within a couple of years. It seems like.
The actual statistic is 91% of the people that actually start a second policy within a year.
There you go. And oftentimes it's on they're a kids or a spouse or someone like that too, by the way.
And after I heard you guys talk about that years ago, I was like, wait a second, I'm not going to start. Why am I starting small? I got to start bigger, right? I want to find something that's bigger. So I don't have 15 policies.
You New York guys. That's
bigger first, right?
Man, you New York guys. I love that. That's Joe's whole philosophy. He used to tell me, these people that have 10 or 11 policies, my one policy is bigger than all 10 of theirs.
Exactly. Put together. Come on, go big or stay home.
Right. Not saying a little guy's it's not a bad thing. It was just more of, hey, when you learn that, hey, your experience shows 90% of the people get a second one within, a few months. It's like, well, what am I doing here? I got to think bigger.
Joe wasn't bragging. He was just saying that you don't get an award for the most policies. You get an award for the best banking system.
Exactly.
That's all Joe was saying. Right, Joe?
And you know what? I'd rather monitor 1 than 10. I try to keep it simple, too.
I agree.
And Craig makes a point here about his previous question about newbies. Yeah, so oftentimes when someone hops on a call with us and they're brand new, like they learned about infinite banking a week ago, oftentimes we're kind of hesitant to even start the application process because their mindset may not have caught up yet to infinite banking. to do the application process, because there is a learning curve. Some people, they get it, boom, makes sense, they get into it. But a lot of people, there is a bit of a journey you got to go through first before it makes sense to start the application process. But yeah, I mean, I have a lot of clients that are new to this, and we're hopping on, we're going through questions, we're giving them homework, or giving them advice, giving them some resources. So, but yeah, I mean, and we have a ton of resources. I believe that we have more educational resources than anybody else on infinite banking out there. You know, Chris's YouTube channel is ridiculous.
Another, and I love this question, Craig. So you're asking really good questions for the listener. So thank you for that.
Yeah.
But when it comes to this, like Brian said, I can count on one hand how many people out of 1,000 calls I moved forward on the first call last year. Unless you're coming in really knowing what you want, you already know what your premium is going to be, you know why you're doing it, you can tell me, and I can basically say, why should I let you move forward? And you can tell me and actually be super certain on it. I'm not moving you forward, because there's still something you haven't asked, there's something you haven't learned, you're not clear on your vision. Most people aren't clear when they're just starting this, to your point, Craig, on where they want to go. And so it's really up to us to help them find one thing to solve and then tie that to where they want to be in 10 years. At least that's how I do it.
Yeah. What's the question you get, Jason, when someone says, they ask, hey, Jason, what question am I not asking? I get that one quite a bit. It's like, well, the question you're not asking is the question that you should be asking, but you haven't yet got there yet. That's kind of
that's what you say. I love that. I mean, write that down for me and send it to me. I say, oh, that is an awesome question. What's the thing that you're afraid to ask, or the thing that you haven't asked me because you might think it's dumb?
That's a good one too.
My first call is usually questions and answers, and I want to see where your mindset is. Want to see where the blockage is and see if we can overcome that with different activities and different things that I say and different scenarios. Usually I bring in real life examples as to let you understand it, because your brain needs to see the left side and the right side and bring it together. You have to understand and realize that everything that they are telling us to do is to benefit them. And now when we do what they do, like the banks putting their money into insurance, and that's what we do, we're taking control, and now we will be making the money. It's just totally opposite and backwards, and that is the real problem.
It's like Seinfeld, Costanza, just, it's backwards day, just do everything backwards, you'll have success. Brian, do we make it through all of them?
Yep, we did. So we got through another. Oh, well, and then of course you got this one. So Pennsylvania, same, started with 30K dump, ended up with a 100K dump. There you go. Love it. So good comment right there.
Awesome.
All three. Look at that. Nice.
Yeah. Yes. And the vault actually is a big thing right now. The vault helps a lot with understanding and helping people plan infinite banking in their lives. So I love that. But we made it through another Ask Me Anything. So once again, everybody, did I put in the 3-day event in there? Let me go and see if I did that or not. So we have the 3-day event, the blueprint coming up here next week. I'm going to go ahead and put that in the comment box. Go ahead and definitely go check that out. That is going to be a really phenomenal event. A lot of us here on the screen are going to be speaking at that event. We're bringing in a lot of advisors. There's going to be investment individuals there, estate planning. I'm actually building the webinar right now for the one I'm doing tonight. I'm not done with it yet. I got my buddy Michael coming in about resort land, note strategies, manufactured mobile home strategies, infinite banking, HELOCs, how to create your family constitution, all that kind of stuff. So it's going to be a lot of stuff. Definitely check it out with that link right there. So with that, any last parting words, anybody?
No, just grateful for your time. It's the most valuable asset you have. So keep coming and learning. We've had new people here. We got people that are always here. Bring somebody, invite them. Like if you liked what we're sharing, spread this message, help us spread the message. There's not enough of us to really serve everyone that needs to be doing this. So keep spreading the message. You never know who you're going to impact. So thanks for being here.
And Douglas, yes, I definitely recommend the 3-day. Every time we do it, everybody loves it. So it's going to be a lot of stuff. So with that, everybody, we'll see you next week, or I'll see some of you actually tonight, and hopefully see you guys in the 3-day.
Take care.
Take care.